Okay, so the first question, Hashim has a business selling phones. A customer, Shaf, returns a damaged phone which he has previously bought on credit. So Shaf is a trade receivable. He's a customer. He's bought something, so Hashim's made a sale and it's been returned. So sales returns is going to be important. So our source document, well, if Shaf's returns something to Hashim, Hashim will then need to issue a credit note. So the source document is credit note issued. Yeah, if the business was Shaf, his would be credit note received because he's receiving the credit note. Hashim's issuing the credit note. The book of prime entry. Well, sales returns, journal. And debit and credit. Well, one account is definitely going to be sales returns, and the other account, since it's on credit, is going to be the trade receivable, which is Shaf. So the trade receivable Shaf, his balance has gone down because he's going to owe less. So he's an asset. So if an asset goes down to credit, and sales returns, that's going to go up. So that's debit. And again, the easiest way to think of sales returns, sales is always a credit, so sales returns is a debit. Okay, so that's the first one. Hopefully you got that one right. Okay, second one, Hashim has bought a scooter for £15,000 to use to deliver his phones to his customers. So that means business use, not personal use. He depreciates it by 20% per annum using the reducing balance method. After 3 years, he sells it for £7,000. So balance reducing method means that we need to do 20% each year. It's not the same 20%, it's the new 20%. So for example, depreciation for year 1 would be 15% times 0.2, which would be 3,000. So the net book value after 1 year would be 15,000, take away 3,000, which is 12,000. Yeah, you then need to do depreciation for the second year on that. So you do 12,000 times 0.2, which would give us 2,400. You would take that away from the 12,000, which would give 9,600. So that's the net book value after 2 years. And depreciation for the third year, you would do 9,600 times 0.2, which I'm going to need my calculator for that one. 1,920. You then take that away, 9,600, take away 1,920, which would give us 7,680. Or if you can remember from GCSE, the quicker way of getting net book values for compound interest would just be 15,000 times, well, we're going to keep 80%, and we're going to do that for 3 years, and that will give us that straight away. So that's how much it's worth. But we sold it for 7,000, or Hashim sold it for 7,000, so he's made a loss of that. Net book value, take away the selling price, gives us 680, or disposal proceeds, I should call that, rather than the selling price. So it's a loss of 680. Yeah, so you can do all this if you want, if that helps, or you can just do it in one line using your math skills. Okay, third one. Hashim's accounting year ends 30th of April. So that's April 2020. So that means it starts in May 2019. He has put 1,600 commission paid on his income statement. So since it's paid, that means it's an expense. However, he still owes 900 commission for the 6 months ending August 2020, so 6 months back from August. So August, July, June, May, April, March 2020. So these are the 6 months. Let's just double check. March, April, May, June, July, August. Yeah, they're the 6 months that he still owes. So in those 6 months, 2 of them should go on his income statement. So 2 months are owed. So we do £900 because that's how much the 6 months he owes for the 6 months. divided by 6 to get how much he owes for 1 month, which is £150 per month. He owes 2 months, so you do 2 times 150 to get £300. So for this accounting year, he owes £300, and since he owes it, he should have paid it this year. So we added on. So we do 1,600, add on 300, which gives 1,900. That goes in the income statement for the commission paid, and on the soft, since he owes the money, it's a current liability, which we call other payables, as 300. Yeah, the other 600, so from May to August, we don't care about. That's next year's expense. So the fact it isn't paid now isn't an issue. You can pay that the next accounting year. Okay, fourth one. Hashim has withdrew £50 from the business bank account for business use by debiting bank and crediting cash. So he's done this. Bank, cash. So he's debited bank by 50, credited cash by 50. But let's see what he should have done. So if he's withdrew £50 from the bank account, that means money's went out of the bank. So it should have been on the credit side. And he's now got more money in cash. So that should have been on the debit side. So to fix it, well, I need to put the 50 on the credit side to cancel that out. Then I need that 50. So altogether I need 100 on the credit side. Same here, I need 50 to cancel that 50 out, plus the new 50 to make 100. So the general journal would look like debit, credit. We're going to debit the cash by 100 and credit the bank by 100. Now, this is one way he's put them on the wrong side. So this is error of reversal or complete reversal. Yeah, and you can always spot these ones as well, because error of reversal ones are the ones where you have to double the amount. So like 50, so we ended up being doubled to be 100. Okay, and last one. Hashim has sold £300 worth of goods to Shaf on a sale or return basis. Remember, that just means that he essentially hasn't sold anything to Shaf. Shaf's selling the goods for him, and the goods won't be recorded until Shaf sells them on. So Shaf has not yet sold goods, but Hashim has included the sales in his accounts. What is the name of the accounting concept that needs to be applied? Well, realization. Yeah, that's when we don't recognize or we don't realize a transaction until the ownership is changed. So it's still, the goods still belong to Hashim. How should the financial statements be adjusted? Well, he's included the sale in his accounts, so he shouldn't have. So the sales, we have to take away £300 from the sales. Trade receivables, and in particular, Shaf's account, we need to take away £300 from there. So we haven't sold it to Shaf until he sells it on. And the inventory, so the closing inventory on the income statement and just the inventory in the soft, we have to add the 300 back onto it. Yeah, because we still have those goods until Shaf sells them. Although we physically don't have them, or Hashim physically doesn't have them, they still belong to Hashim until Shaf sells them. That's what's so important about sale or return. Yeah. Hopefully you've got 5 out of 5.